Once again, thank you for joining the fifth program of this 8-part webinar series. We want to recognize our series sponsors, as you'll see on the slide here, particularly the voltage sponsor, Constellation, the Nuclear Powers Maryland organization, Siemens, based with headquarters based in Beltsville, our partner with the Maryland, the Morgan State University project, and our series sponsor, CohnReznick, and we're happy to have a speaker from CohnReznick on today's panel. It's my pleasure to welcome our special guest for today's program. I do want to thank all of our panelists. In particular, our moderator for today is Jason Schwartzberg, who is the president of Maryland Energy Advisors. After identifying the need for diverse and approachable energy company focused on unparalleled customer service, Jason is co-founded Maryland Energy Advisors in 2010 as a night and weekend project with 2 business partners and $10,000. Focusing on anticipating and solving energy problems and reducing energy spend to maximize profitability, the company was sustainable by late 2012, and he and his business partners took a leap of faith to focus on the business full-time. Through his leadership, Maryland Energy Advisors has grown from humble beginnings to 25 full-time employees. Service offerings include energy brokerage, energy efficiency, renewables, energy staffing, and C-PACE financing. Jason is an alumni, past president of the Alumni Association from McDonough School and the Real Estate Committee for the Associated Board of Directors of Northwest Hospital. He earned his Master of Business Administration from Loyola University and a bachelor's degree in government from Franklin and Marshall College. He recently graduated from Goldman Sachs' 10,000 Small Business Program and ICIC's Inner City Capital Connections Executive Leadership Training Program. Jason, welcome, and thanks for moderating today.
Thank you. Good morning. Good morning, everyone, and thank you for joining us for Building and Bankrolling Energy Projects. As Kathy mentioned, I'm Jason Schwartzberg and have the pleasure of moderating the panel this morning. We have close to 100 registered for this event, and as you saw from the polling, we have folks representing the utilities, the universities, local government, and energy companies. This morning, we're going to provide you with an overview of both public and private sector financing solutions that can help jumpstart your energy projects. Our intention is for this to be free-flowing, so please feel free to type any questions in the Q&A box at the bottom of your screen. Joining me this morning are Brian Garcia, President and CEO of the Connecticut Green Bank, Kerry O'Neill, CEO, Inclusive Prosperity Capital, Ben Rupert, Energy Project and Procurement Manager, Maryland Clean Energy Center, Abby Johnson, President of Abacus Property Solutions, and Joel Cohn with CohnReznick. We wanted to have an additional panel prior to starting our conversation with what are the biggest obstacles, additional polling. What are the biggest obstacles to completing your clean energy projects? And in a moment, the poll will come up. This will be a good jumping off start for our panelists this morning. So while the results of the poll are coming in, I would like to introduce our first panel discussion, where we'll focus on public and quasi-public sector financing options that are available to finance energy projects. This panel will feature Brian, Kerry, and Ben. And Brian, good morning. If you could please introduce yourself to the guests and provide an introduction to yourself and the Connecticut Green Bank.
Excellent. Good morning, everyone. Thank you, Jason, for that introduction. I wanted to start off thanking Kathy and Sabrina and the Maryland Clean Energy Center team for inviting us all to be a part of today's panel. And of course, my favorite Maryland Senator, Senator Chris Van Hollen, who pioneered the Green Bank public policy over a decade ago through the American Clean Energy and Securities Act of 2009. At the time, it was called the Clean Energy and Development Authority when he proposed it as a congressman, and here he is today as a senator proposing it as the Clean Energy and Sustainability Accelerator. So just a big shout out to Senator Van Hollen. The Connecticut Green Bank is the nation's first state level green bank. It was created through a bipartisan act of legislation in July of 2011. We're a quasi-public organization, which essentially means that we use private sector disciplines to achieve public sector goals. You could think of us as an intermediary between the ambitious climate change and clean energy policies of the state and the private capital markets that we're helping attract to enable their investment in our economy. We focus on delivering social and environmental impact for Connecticut as opposed to financial profit. Our mission is to confront climate change, and by ensuring that we're helping vulnerable communities first, we can truly solve our environmental problems. Now, we're actually celebrating our 10-year anniversary and have invested nearly $300 million of public revenues over the last 10 years to mobilize $1.9 billion of private investment for a total of nearly $2.2 billion in Connecticut's green economy. That has achieved a leverage ratio of $7 of private funds to every $1 of public funds. And we invest the public funds. We don't grant it out or give it away. We invest it with the expectation of getting it back over time. We've helped deploy nearly 500 megawatts of renewable energy, including energy efficiency in our communities. This has helped create over 25,000 jobs, reduce the energy burden on over 57,000 families and 6,000 businesses, especially those within our most vulnerable communities. As you drive more investment in the economy, of course, you generate state tax revenues. So we've helped generate over $100 million in state tax revenues. And as you deploy more clean energy, of course, you get the reduction of greenhouse gas emissions. So we've helped to avoid nearly 10 million metric tons of CO2 emissions that cause climate change. And then displacing dirty, polluting power plants, we've helped avoid over $300 million in public health costs as a result of cleaner air. With all of this impact, it's important to point out that we all need to ensure that we're enabling more public and private investment in vulnerable communities. Each state has its definitions. We all know that these are populations who have contributed the least to the problem of climate change, but bear the highest burden in terms of its impact. Connecticut is a solar with justice state, which means that our low to moderate income families are demanding solar PV on par with non-low to moderate income families. And our communities of color, our Black and Hispanic families, are demanding solar PV, in fact, more than white families here in the state of Connecticut. Let's go to the next slide. The Green Bank model is a public policy innovation. As we know, the Paris Agreement is a stool with three legs. First, mitigating greenhouse gas emissions to hold the increase in global average temperatures to well below 2 degrees Celsius. Second, increasing our ability to adapt to the impacts of climate change and foster climate resilience. And thirdly, where green banks are a tool, is making finance flows consistent with mitigation and adaptation. Green banks leverage limited public resources to attract and mobilize multiples of private capital investment. I wanted to speak about a few examples from Connecticut. To support our state's comprehensive energy strategy, we have a residential loan program called the Smart E-Loan. That is a home solution program for the Green Bank. Using the strength of our balance sheet, we provide a second loan loss reserve to local community banks and credit unions to provide unsecured, easy and affordable access to loans for single-family homeowners that want to finance clean energy improvements on their properties. Things like insulation in their walls, more efficient heating and cooling equipment, solar on their rooftops, battery storage for emergency backup. We've helped support nearly 5,500 projects totaling over $100 million of investment. By providing this credit enhancement, the Green Bank has had to reimburse participating lenders less than $75,000 for their investing over $100 million in loans. That is an excellent leverage ratio and a demonstration of the power of a Green Bank. We're teaching lenders that investing in the clean energy and climate change policies of Connecticut is good for business. Inclusive Prosperity Capital, Carrie O'Neill, our colleague here, is helping to administer the Smart E-Loan program for us. Secondly, to support the economic development objective of reducing energy costs on our businesses, we have a commercial and industrial program called CPACE, which is part of our building solutions line of programs. Through a benefit assessment policy called Commercial Property Assessed Clean Energy, or CPACE, nearly 140 of Connecticut's 169 cities and towns have voluntarily agreed to support clean energy improvements for their businesses, nonprofits, and multifamily property owners. CPACE finances clean energy improvements on their properties similar to the residential Smarty loan that I talked about, but can also support industrial process improvements as well. We've supported 350 projects totaling over $200 million of investment, of which $50 million of that investment is from the Green Bank, and the rest is from private capital. This has helped saving those businesses over $300 million in avoided energy costs over the life of the projects. To also help reduce the energy burden on nonprofits, multifamily, affordable housing, and municipal end-use customers, we also offer a Green Bank Solar Power Purchase Agreement product in collaboration with Inclusive Prosperity Capital. And I think Carrie is going to speak to that in a second. We have a number of products and programs that we offer for home and building solutions. Green banks like Connecticut and Maryland are at the local and state level across this country and at the national level around the world. Green banks are a growing and important tool to filling the financing gap for tackling climate change and enabling the energy transition, because we de-risk markets for investment from private capital sources. And lastly, as an investment solution, the Connecticut Green Bank has the ability to issue revenue bonds. Last year, in honor of the 50th anniversary of Earth Day, we issued our inaugural Green Liberty Bond. The Green Liberty Bond is modeled after the war bonds of the 1940s, where more than 85 million Americans invested over $185 billion to support the war effort and defend democracy. As part of our goal to advance market transformation, we want to see bond markets support more retail investors, everyday citizens having the ability to invest in their government to confront climate change through their wallets, in addition to the ballot box. Anyone can issue a Green Liberty Bond. Think of it as a subset of a green bond, except you have to make sure of the following three things. First, that the bond proceeds are being invested in actions that support the Paris Agreement. They mitigate greenhouse gas emissions or become more resilient to the impacts of climate change. Second, the denomination values can't exceed $1,000. These are retail bonds. The lower the denomination value, the better, and we're aspiring towards a $100 value. Third, since these are retail bonds, they should be independently certified and verified as a form of consumer protection. On Earth Day this year, we had $25 million of bonds to issue. We had nearly $100 million of demand for those bonds, including from the citizens of Connecticut and across the country, as well as ESG investors in sustainable communities across the country. So that's just a quick overview of the Connecticut Green Bank. Glad to be here.
Thank you, Brian. That was very, very helpful and very interesting how the Green Bank has intentionally served the different segments of the market. I'd like, if we could we please share the results of the poll? So it looks like access to financing, technical support, siting, ROI, they all appear to be obstacles to building and bankrolling energy projects. So we'll do our best to address each of these through the panel discussions this morning. Hi, Carrie, good morning. Inclusive Prosperity focuses on investment, on helping create access to clean energy and efficiency solutions for underserved markets. If you wouldn't mind, could you please introduce yourself, your company, and share some examples with our audience?
Sure thing. Thanks, Jason, and the Maryland Clean Energy Center for inviting us on. And thanks, Brian, for that great tee-up. We are a not-for-profit investment fund. We are a form of a green bank, a boundaryless green bank, because we operate nationally. And our origin story is that we worked at the Connecticut Green Bank to innovate a number of solutions that, as Brian talked about, have had great impact in Connecticut. And we saw an opportunity to expand that impact by spinning out Inclusive Prosperity Capital from the Connecticut Green Bank to take the show on the road, as it were, and work nationally. So things like the Smarty loan program that Brian mentioned, we are passionate about teaching local lenders all across the country how to get involved in offering homeowners, an unsecured, easy loan product to make upgrades in their home, including low income and credit challenged customers, by working with mission-oriented credit union and CDFI lenders in local communities. Or offering, as Brian talked about, the Green Bank PPA product, where we can work with the types of buildings and properties that are harder to finance: houses of worship, affordable multifamily housing, small businesses, and give them an opportunity to go solar. And Inclusive Prosperity Capital is very much committed, as Brian talked about, Connecticut Green Bank is as well, to making sure that nobody is left behind in the clean energy transition. So I wanted to pick up on the theme of these barriers that you just did the poll on, and talk about a very specific product that we innovated in Connecticut and we now offer nationally, called the Catalyst Loan Program, where it's addressing issues in multifamily housing and nonprofit buildings, and designed a very specific loan product to meet the needs. And the challenges that we were solving for in Connecticut, starting with affordable multifamily housing, had to do with the fact that for many of these properties, you can't, because of other covenants and other debt restrictions on the property, you can't add additional mortgage secured debt. Another issue you face in this market is that you may be mid-cycle, not at a capitalization event. You don't want to, deal with prepayment penalties, but you've got an issue and you need to address it. So if you can't roll it into the mortgage, how can you do mid-cycle financing? So we've kind of put all those things together to create a loan product that allowed us to underwrite to energy and operations and maintenance savings, basically unlock the energy savings and the other savings that we know exist in our buildings if we can get in there and do the energy upgrades that are required. And so we underwrite to all of those savings, and we make sure that the debt service is less than those projected savings, any kind of savings that you can document, including insurance savings. And this has allowed us to, offer financing to buildings that otherwise are being turned down by, their local lenders because they can't do mortgage secured debt, or the local lenders not familiar with how to underwrite these energy and operations and maintenance savings. So many of our nonprofit buildings and our affordable multifamily buildings, are really suffering crushing energy burdens. And so this sort of technically oriented financing allows us to unlock and open up new markets that otherwise might be off the table. And in Connecticut, we've had great success partnering with a CDFI to be able to get at these properties. And I think, Brian, at this point, we've touched something like 10% of the multifamily units in the state. Really a phenomenal success story. In our industry, that sort of penetration is a really, really big deal. As we all know, we have lots of work to do, hence a webinar like this. And this approach to underwriting to energy savings and other operations and maintenance savings is something that we're partnering with other green banks across the country on, in Philadelphia and Texas and Michigan, to bring these strategies to new markets. Sometimes, though, we are in markets where energy costs are quite low and you can't just underwrite to energy savings. So we have the flexibility to do a traditional property-based underwrite as well. If we're in, and we're in new markets now, like Texas, where the energy costs may not sustain the debt service on their own. So this kind of core approach is something that we can adapt to lots of different markets. One other thing I'll just mention in terms of other barriers that we face in this market. I think the ROI and technical assistance was mentioned as well. For many property owners, they don't know where to start, and there's engineering and design work that needs to be done. So in Connecticut, we created a pre-development loan that we also now offer at Inclusive Prosperity Capital across the country, called the Navigator Loan. And this allows us to de-risk those pre-development activities for owners. So we'll finance up to 75% of those pre-development activities. And this loan is almost like a credit card for pre-development. We disperse based on bills that are coming in that we approve. It gets paid out when that project moves to construction or permanent financing. And I think that's one of the themes of the Connecticut Green Bank and green banks generally, is really working deeply in a market and an ecosystem and getting to understand what are the specific challenges and how can we create solutions that meet those challenges. So let me pause there, Jason, and looking forward to the conversation. Hopefully that gives a sense of different ways that we can address challenging markets.
Carrie, thank you. I had two quick follow-up questions. What are some of the eligible energy improvements? And to that, what's like a sweet spot loan size, lower limits, upper limits for your program?
Yeah. So on the energy improvements, it's basically anything that's saving energy or generating clean energy. But if there are enough savings to support other measures, we can also do water saving measures, roof repair, health and safety. And so in Connecticut, we've got some amazing, success stories of loans where we've worked with, a naturally occurring affordable housing complex that had crushing energy burdens, was able to fix that. But there were so many energy savings, they were able to fix roof leaks and put in LED lighting for safety. There are a lot of elderly residents and things like that. So it's a very flexible product. A lot of solar has been done, EV charging, kind of the whole gamut can be done there. And then what was your second question, Jason? The sweet spot of the loan size. Yeah. So another really important gap here is, smaller loan sizes are harder, right? And so this is very specifically designed to go all the way down to a very small $50,000 loan, all the way up to a $2 million loan. And we could probably go a little bit higher. We'd have to get our board to an investment committee to approve it if it were a really worthy project. But our published terms are $50,000 to $2 million. And it's quite interesting. In Connecticut, technically the average is $330,000, but I would say it's a little bit of a barbell. We see a lot of loans that are like sub 200, 175, 150K, and then some bigger loans that have brought up the average loan size, because we've got some properties that just have extensive needs. And so we've done, a couple of $2 million loans, so it's, a little bit of a barbell, I would say.
Is just for the audience, is there a rough interest rate range that folks should...
We have published rates on this, and so remember, this is not a mortgage secured product. Everybody thinks mortgages when they think these sorts of rates. This is lightly secured with a UCC1 filing. So at 7 years, it's 5.79%, and then it kind of escalates up to 20 years at 6.99%. We will not allow the term to go out farther than the average useful life of the measures, because we are underwriting to those energy and operations and maintenance savings.
Thank you. Ben, good morning. We have Ben here with the Maryland Clean Energy Center. The Maryland Clean Energy Center functions very, very similar. It is a green bank. One of the polling questions that we saw was technical and procurement support for projects. So looking forward to your overview of the programs offered and how we can unlock some of these options by aiding with technical and procurement support. So take it away, Ben.
Thank you, Jason. Yes, so I am Ben Rupert. I am the Energy Project and Procurement Manager at the Maryland Clean Energy Center, which I will refer to as MCEC, I think, moving forward here. And excuse me, I've spent the last 15 years somehow developing, creatively financing, and implementing clean energy projects and programs in the public and private sectors. And I've been on board at MCEC since just May of this year. And it has been a whirlwind. It feels like a lot longer in a good way. I say that in the best way possible. It's been a great few months so far. And during my time in the clean energy industry to date, I have encountered all manner of barriers, as I'm sure many in the webinar have. So I'm really glad to have landed in an organization and sector, I think as Brian so well described when he described green banks. So an organization and sector that is working on removing the barriers that I have definitely encountered a plethora of, as I'm sure many others have too. So MCEC, we are a quasi-public nonprofit entity established specifically to facilitate private investment in low carbon, climate resilient infrastructure and clean energy projects, which is in fact the Organization for Economic Cooperation and Development, or the OECD's definition of a green bank. So we are literally a green bank according to the OECD. My primary objective in my role with MCEC is to provide direct procurement and technical support to clients and partners throughout the state in order to improve access to and to mobilize capital. And so certainly financing is a barrier, as I think my colleagues have well kind of described. And we are definitely trying to expand and be as creative as possible as we evolve to meet the needs and to try to adapt and overcome barriers that we're finding within our region and more broadly. And some examples of specific service offerings for MCEC include, of course, mobilization of capital and securing access to capital. We have secured over $45 million in public-private financing for energy performance contracts so far to date for our organization. And so energy performance contracting is definitely something we facilitate and help with, but then we also want to go beyond that. And so in order to do that, we are also providing direct procurement support. This is related to Jason's question. Jason, thank you for teeing it up for me, but we are providing direct procurement support to various public and private entities. And a good example of this is, and of going beyond energy performance contracting, is a master service agreement that we have with Morgan State University. And so through a master service agreement, we're able to certainly help Morgan State, help MSU develop energy performance contracts and energy performance services. But then we're expanding beyond that to also allow for the same competitive process to also cover energy related infrastructure and other clean energy related resiliency projects that don't fit in with the scope of energy performance contracting. And so some reasons for that, is probably many of you on the webinar are aware, include that with an energy performance contract, certainly we generally speaking want to make it as large a project as possible. So we have some quick return on investment items coupled with some longer payback measures, or some measures that we know are going to provide benefit but have a more questionable, I would say, savings forecast. Those could be operations and maintenance savings, things like that. But even when we make that as big as we can, we still have to fit within the financing needs of the energy performance contract and perhaps other payback kind of policy or structures, payback terms that sometimes mean that we can't do everything we want to through a simple energy performance contract. So through this master service agreement process, we're basically able to do more than energy performance contracting with streamlined procurement for those still very targeted clean energy projects. And one other area that we provide assistance with is technical support. And an example of this is local school district, Baltimore City Public Schools, we provide advisory services to them and help them with items such as review of investment grade audits. An investment grade audit is essentially the backbone of an energy performance contract for those of you who don't do this day in and day out. So we will, for instance, provide technical support to an entity like Baltimore City Public Schools on that very specific process, that very specific item. And as we move ahead, we're working on getting as creative as we can in order to remove persistent barriers to project implementation that we're all aware of, and also to make sure that we're listening well to our constituents, our clients, to identify and help to remove emerging barriers and things that we maybe are seeing based on, I think, proactive and positive policy, some bottlenecks to getting projects completed. And anyway, so we're trying to be creative and certainly are very, very happy to be in the cohort of green banks that Brian so well described earlier. And I will leave it at that and turn it back over to Jason, I think.
Yeah, Ben, thank you. So it sounds like you have kind of two distinct populations. You have the private sector, the public sector. What if someone has a project that they think might be a good fit, or they need technical resources? Like, what's the best way to contact the MCEC, or what's the intake look like?
Yeah, that is a great question, and the answer is our website. I mean, I will certainly, for those of you on the webinar today, my contact info will be provided, but our website will be the best introductory point for folks, and through. And that is if you just are aware of a project needing assistance in the region that we serve, which is the state of Maryland, anywhere. And so, yeah, so the website is going to be basically the gateway for us and the way to make the best contact. And you'll also see our specific program offerings there. And those are growing all the time. So that's going to be the best way to contact us. And my contact info will, of course, be available to everyone here too.
Similar to the question to Carrie, is there a sweet spot project size, upper limit, lower limit?
That is a great question, and it depends is the answer. So we have several different programs that we actually are responsible for in Maryland, and because we are a quasi-state entity, and so we, for example, are responsible for the Maryland PACE program, Property Assessed Clean Energy program, and that program, although it has recently been expanded, which I think is fantastic, so we can do more with it. The scope of PACE finance projects can be greater. Payback term can be extended. Even with those expansions, still that's going to be a larger project size. And I don't have I can get the specific dollar amounts, but I honestly don't have. Oh, my energy efficiency measure just turned off my lights. Sorry about that. See if I can, there it goes. I can get the dollar amount, but so something like PACE is going to be certainly a financing capital program for larger projects, but then we also are, and I'm sure it's okay for me to mention publicly, but we're in the process. We are very soon going to be officially publicly launching a program called the Clean Energy Advantage Loan Program, which is an expansion of a low interest, residentially focused loan program for energy efficiency measures. So you can look for more information from on that very soon. And of course, that with the residential focus is going to apply, certainly to single family residences, and it's going to be for smaller project size, excuse me. And the other thing that I do want to say regarding project size is one of my focuses throughout my career, even prior to coming to MCEC, has been trying to mobilize projects in kind of the small to mid-size commercial sector. And so that's something that we're working on. And we don't have a specific program offering for it, but certainly it's something that we want to provide support on. And we can provide, I would say, custom procurement support at this time for that market. And we also have a focus on trying to do what we can to mobilize support for that market as we move ahead. So yeah, so for us, I guess, and for a more concise answer, I would say we can help with a wide array of projects, and we have specific programs that are designed for large and small, and looking for something for the middle, I think is a good way to put that now.
Yeah, no, that's great. And it's my understanding that the CEA program is being developed through a partnership with the Montgomery County Green Bank. So excited
Yeah.
to see that all come together.
Yeah, that's correct. Yeah, that's correct, Jason.
Great. Well, Brian, Carrie, Ben, great Green Bank overview. I think the audience has a much better idea of where these specific tools play, project types, project sizes, financing rates. So I think that was a fantastic overview. I'd like to transition to our next mini panel with Abby and Joel. Really very appreciative that you've been so patient. I want to make sure we're bringing you into the conversation. This portion of the panel will focus on private sector financing. That's available for energy projects, often some larger projects above the $2 million caps that have been mentioned. Joel, your firm CohnReznick has a national and international exposure to the energy marketplace. Which projects are getting financed? Is it storage, renewables, performance contracts, and which has the pandemic had any impact on these projects?
Thanks, Jason. I appreciate it. And thanks for the invitation to join today. So CohnReznick is a public accounting firm, as Jason, you may have mentioned, provide traditional services of a public accounting firm, but we also have a dedicated renewable energy practice, about 100 staff total in the practice, working full-time in serving in different capacities our renewable energy clients. Those could be developers of renewable energy projects, EPCs, investors, and certainly many other stakeholders in a variety of capacities, including valuation, traditional audit and tax services. We have an investment banking company for very large transactions. And what I do, which is a consulting role, which is advising clients on accessing and optimizing the benefits that are available in the federal tax law and the Internal Revenue Code. And sort of staying on the right side of the line in those dark corners of the tax law so that there are no sort of foot faults by our clients or any participants in the transactions. And I'm kind of humbled to be, I am humbled to be part of this panel and hearing what some of the other previous speakers spoke of and how they're driving change and certainly for the better in the industry and in our economy and in our country. Other than some policy folks, we tend not to be so much drivers of change, but to your question, Jason, have line of sight on some of the trends and the issues that are being faced and opportunities that exist on a very current basis. There is, as a general rule, plenty of capital chasing renewable energy projects, particularly, admittedly, if you have or need a very large check size. And that'll present issue number one in direct response to your question. We see investment coming in from some of the cheapest money in the world, which is long-term pension fund and insurance company money, either from the US or from Canada, Europe, and Israel, and the UK. And I think that in a number of those other countries, they see the growth that will continue in the US and the opportunity here. But they're typically very large institutions and are looking for, as I said, very large check sizes. So historically what we've seen is that utility scale projects were able to attract capital, and residential portfolios were able to attract capital because people could evaluate a consumer portfolio based on, say, a FICO score level and say, I've got a commodity and therefore I can put 10,000 in. I know some are going to fail. And, if X% are above a certain FICO score, I can sort of figure it's a fairly homogeneous pull and underwrite. It's the distributed generation, the commercial industrial, the sort of hole in the donut kind of projects that have struggled. And one of the reasons why they struggled, you might be thinking about aggregating those facilities to create a large portfolio to justify whatever check sizes are required by those financiers. Naturally, like all of us, the financiers would rather work less rather than more. So to the extent that there are more and different projects with different off-takers and different site leases and maybe different interconnection agreements, there's a lot more underwriting effort involved in a portfolio of distributed generation projects, or there tends to be, than there might be with the perceived homogeneous portfolio of resi or the single utility scale or maybe two project utility scale portfolio. So, DG has always been a challenge, even with availability of capital. I want to make a distinction. The second part of the capital stack, the first part of the capital stack, when I was referring to availability of capital, is those institutions with a long-term time horizon that are interested in the cash flows for these facilities. As I'm sure everyone in the audience knows, often a second key element of the capital stacks for these projects or the financing sources is what people refer to as tax equity. These projects often generate tax credits and always generate depreciation or eligible to do so. It tends to be a shortage of tax equity in the markets. Tax equity, like the other financiers, tends to favor larger projects or the residential portfolios. And even then, there's still a lack of balance between supply and demand. So, one of the trends we're seeing, interestingly, and it relates somewhat to what some of the earlier speakers mentioned, is finally more of what we in our industry refer to as the corporates. It's not the financial institutions, it's the retailers and tech companies and others that all of us solicit on a regular basis in our daily lives, that are seeing that they can do not just the so-called greenwashing, invest in a solar project and put the pictures in the annual report, but achieving certain direct and required ESG goals for their organization, substantial investments in this space, are required to also meet certain diversity and inclusion goals. And we're seeing a much more mission-oriented investment approach where those organizations might pay more than they might otherwise. But you have these corporates, rather than just diversifying as it relates to, say, their supplier of cleaning supplies in their facilities or the forklifts in their warehouses, they're looking for diversity in their electricity vendors. So they're looking for companies that can sell them electricity that may be majority minority owned, or those developers of these renewable energy projects selling electricity also have certain diversity inclusion goals for their staff, for their contractors. They're maybe funding a community benefits program that involves job training even after this, say, the solar project construction is completed, educational exercises for local schools, and a lot of other much more mission-oriented benefits. So we're seeing sort of somewhat of a lesser degree of profit motive and more of a mission-oriented aspect to some of these projects. So we have, rather than the tax benefits driving these corporates to invest, which has been the traditional approach, we have their ESG initiatives driving these corporates to invest in these projects, and therefore a much more mission-oriented strategy in their investments. And that's certainly encouraging from a lot of respects.
Got it. What has CohnReznick been involved in any of the wind projects here locally in Maryland, or mostly solar, or where do you pick up and put down the pencil when it comes to renewables?
Yeah, that's a great question. I mean, we work on projects all over the country. As I said, we may be a bit of a follower of our clients. So wherever there is a lot of development activity, we'll be working on it. We've had the good fortune to work on some offshore projects all over the Eastern Seaboard. as well as a lot of solar projects. Certainly, historically, Massachusetts and Illinois and New Jersey and each of those states have had their own sort of bell curves in their development activity. Obviously, California and Texas, and we're involved in all those states.
And final question: we have a bunch of different folks on the line: universities, government, private sector, energy companies. When should someone think of CohnReznick?
Well, it's interesting. As maybe many of those folks know, particularly those from the municipal or tax exempt industries, is that historically those organizations have had a harder time participating to some degree in renewable energy projects. They can't lease the facilities, for example. They have to enter into a PPA. They can't own them and access the tax benefits. The $3.5 trillion infrastructure bill includes a proposal that was approved by the Ways and Means Committee, which would allow for those organizations to own these facilities and get what amounts to an income tax refund, instead of having to try and use or monetize these tax credits. And likewise, smaller projects, or maybe in some cases even larger projects, we will be able to get these income tax refunds. In the nomenclature of the tax bill, it's referred to as direct pay. Now, there are a lot of conditions attached to these, to the direct pay, and a lot of other elements of the ITC extension that exists in the bill. And, obviously we all watch the news and see, the continued discussion back and forth about what will happen with the $3.5 trillion infrastructure bill and how much it'll be and what provisions will survive. So, we've got a few months yet for all this to play out, just to know what's in the law, at least a few months. And then, candidly, Jason, a lot of these elements will need additional clarification and rules from the Treasury Department and the IRS. So it wouldn't surprise me if we're well into next year before we have some of these issues resolved and clarity on how to move forward. Hopefully that was responsive to your question.
No, thank you, Joe. I appreciate it. Abby, like to bring you into our conversation here. Your firm has both for-profit and nonprofit arms focusing on energy finance, and in particular, commercial property assessed clean energy financing, which was mentioned by Brian earlier. Hopefully you can provide us an overview of the program, the states that it functions in, and more on the value proposition. So good morning.
Good morning. Actually, I guess it's still good morning in this time zone. Nice to hear everyone talking about the different financing vehicles, both public and private. I am really grateful to be part of this panel, and certainly thanks to you, Jason, MCEC, and all the sponsors for this program specifically in the series this fall. So yes, our specialty is to help develop and finance energy efficiency projects, and we're certainly definitely specialized in PACE. I kind of think a very short story about how we got into PACE might give those listening in an idea of how PACE can be beneficial to their project, or why a local government would like to look at using PACE if they're not doing so already. So I just, I worked in commercial real estate for a long time. My firm, I started during that period of time, kind of in a way like yours, in the sense that I started at a very low budget and was like, what am I doing here? What am I want to doing other than commercial real estate? And with that in mind, I started thinking, really we have to start monetizing energy efficiency renewables into the commercial real estate lexicon. They weren't being appraised that way. They weren't being considered at all in terms of just looking at the value and the cash flow. And, in terms of getting debt, it was not even considered at all. And I was in the West Coast where things were, in theory, very forward thinking, but commercial real estate is a big industry, and it takes a while for things to kind of trickle down, I would say. So what I realized over the years and why I developed this PACE practice is that it's really a vehicle that is more comprehensive than other kinds of financing, and that can provide really a lot of solutions to a lot of different kinds of property owners. But before I actually kind of go into some of your question about PACE and where it is and the kinds of projects that use it, I just want to kind of give a very somewhat simplistic view of how financing looks both with and without energy efficiency type financing. So in the private sector. So this is like, a $12 million renovation project of, say, a historic hotel, for example. You have construction lending, got a construction loan or construction perm loan. You have equity you have to put into the property, and you have incentives. We've heard a lot of great incentives that are available in Connecticut and Maryland and other states. So those are definitely something that probably are always available at some level. You can go to the next slide really quickly, please. Can I do that, or is that something that Sabrina has to do? I think it one back. Perfect, thank you. So this is just a view of what it looks like when you are incorporating energy efficiency or renewable energy type financing products into the capital stack. And of course, and as we heard Joel talk about, there's a lot of complexities that go into different kinds of financing structures. But I would say that when you are able to incorporate them through PPAs, power purchase agreements, or energy service agreements that are usually promulgated by, on the HVAC side or lighting side, and other kinds of shared savings agreements or PACE, you're able to utilize these kinds of vehicles to reduce the capital you need to put into the project. So this basically can make projects that don't otherwise pencil. And I think this is really important to point out that, PACE has become maybe the most prominent. There's securitizations, it's a public-private partnership, but there have been vehicles around for a long time. Per Joel and others' points, power purchase agreements, PPAs are out there. The big, energy service companies like Johnson Controls and Siemens, have been using energy service agreements for a long time, or energy performance contracts. This is also done through MCEC. So they're all vehicles that are really, really valuable. I think that, the reason why PACE is really, I think, in a lot of ways for the private sector shown to be really good in lots of different situations is the way that it's structured and the kinds of projects it can finance and the range of projects it can finance. So the last slide is simply kind of a snapshot of generally where PACE is around the country. I can see that there are folks who signed up anyway, who are from all parts, including California. So you can see that the majority of the country is enabled. And in addition to this is the slide I actually got off PACE Nation, but it's a little farther behind in that Washington State is enabled at this point in time, as is Nevada to a limited degree. Tennessee is not open yet for business, but has passed a statute, and Nebraska also got a program. I think Montana shows that in development. So you see that really the majority of the state of the country is enabled for PACE at the state level. But as many of you know, in order for PACE to work as a voluntary special assessment lien, as Brian talked about earlier, local governments have to allow it through a local ordinance or a resolution. So this takes time, and I would say that we're probably around 2.3 billion at this point in time in commercial PACE over the last 10 years. But we see a really big increase in the interest in PACE, even primarily in new construction, but also large rehabs, because now the industry can say in California, in Texas, Florida, in Maryland, Connecticut, the majority of the state is covered. So if you have, for example, I'm in Virginia, and our state has been locality driven. There's no statewide program or program that covers most of the state, like in Connecticut, like in Pennsylvania, like in Maryland. And so you're going locality by locality. So when you're a property owner, you really want to know that, all of a certain kind of region is enabled so that you can use the product. So I think that's something we're seeing being overcome as PACE really starts to get into the lexicon of both government and the private market. And then, I don't know, one other thing I wanted to point out about PACE, I think we know it's a special assessment lien that doesn't accelerate. It has very large pools of capital that are there waiting to finance PACE projects. And, it's basically non-recourse because it's land-based finance. So there's going to be times where a PPA or ESA is something you want to do that makes sense. I think that PACE is really great because you can do HVAC and lighting and solar and stormwater. You can do up to 30 years in terms in some states. You can do it fixed for a long period of time. There's no corresponding debt requirement like, typical loans. You also have, I think, and this was brought up in the earlier conversation, the ability to do in some states, and I think this is growing, stormwater management and resiliency projects, including in Maryland, which has expanded their statute. I think it's probably the most comprehensive in the country at this point because it has resiliency, it has stormwater, it has a variety of health and safety measures like mold remediation and asbestos removal. So these kinds of having a program that expansive really allows for deep retrofits, but also changes to a structure that really are going to benefit us from a energy efficiency standpoint, but also from a sustainable standpoint going forward. We see it, I think this was also brought up, the fact that insurance companies, pension funds are really looking at, large scale projects, but they're also investing in PACE. And as they become and require ESG as a critical component of their strategy and their investments, PACE can play a really strong role in that by having resilient measures, for example, having the flood proofing, having the backup generation incorporated. And this can also be done, and what we're really focused on is to really be promoting this in the multifamily sector, both affordable and workforce housing, because this is a sector that there's been a few projects, but really it's the area, I think to Carrie's point, that's kind of been excluded because of the fact that there's a lot of moving parts. It's not like a simple, you go to your local bank and get a 5-year loan. So it's becoming simpler and more easy to use, but we really need to crack that nut. So I don't know any other questions you may have, Jason, regarding these.
I think that was a really good overview. You touched on kind of the eligible measures. It seems, it's going to be state specific, but the net is pretty wide. Whether it's renewable energy projects, building envelope, lights, HVAC. I think you also touched on the use cases, energy related capital projects or renewable ground up construction or repositions, depending upon the market. I think it's pretty important, especially for the private sector folks. Could you zero in on that value proposition one more time? I mean, I think you showed the capital stack, but why is the value proposition what it is? What are the rates and terms? What is this replacing in the capital stack? I think those are important points.
Yeah, thanks, Jason. So absolutely. So maybe just go back a slide because again, it's just an example, a little simplified, but it just show you that there's a lot of benefits to PACE, and I would put them in 2 categories: the benefits for a new project, a new development, and the benefits for existing buildings. So starting with new construction or, a gut rehab, an old warehouse you're converting to apartments, for example, I would put that in the new construction field. I think that, what you're seeing is that PACE can come in at 100% financing. So no out of pocket, come in and take a portion of that project. Say you have a $20 million project, or let's say 12 million, it's here, $12 million project. And you would normally have to be putting in $2.5 or $3 million of equity. And if you have PACE, you basically can say, I'm going to use PACE to pay for the solar or for the stormwater management or for the windows. And that really is pulled out of the total cost of the project in terms of the equity requirement. So you're reducing your equity upfront that's required. And if you want to, you can keep that on the books for as long as those eligible measures have a useful life, or you can, and it has happened multiple times, that at some point in time when this project is stabilized, it can be converted to permanent financing. And maybe at that point, it's also possible with the increased valuation based on the lease terms and the net operating income, you can take out the PACE. So it's meant to be a long-term solution, but we've seen, many times that it can be used to really help fill that gap in the capital stack. We've also seen it be really important from the standpoint of when there's been the difficulties in the last year and a half. There's been many projects that would not pencil if they couldn't use PACE, but use PACE retroactively. So for example, say you have a property you built a hotel, and you finish the hotel, and you're in a state that, like Maryland, that allows for look-back financing, and your occupancy levels have just not achieved what you need to really cover and maintain the debt service coverage that's really required of your lender, your primary lender. And so you can actually go, okay, assuming that a certain number of eligible measures qualify per the program today, PACE lenders will come in and provide you, say, $2 million or $5 million or $10 million of PACE and allow you to pull out that cash. And we've seen this to be a really valuable use of PACE. Further, I think, although interest rates are not, I get a lot of questions from developers. They say, well, you're not as inexpensive. PACE is not as inexpensive as my construction lender. Well, that's true. You're not going to get 4%. You're going to get upper 5s, maybe 6 in most cases. But it's fixed rate. It's long term. It's non-recourse. And, it's something that really offers the ability to finance measures that perhaps your bank wouldn't finance. And it may provide other ancillary benefits than just, I don't have to put as much capital in. It allows you to reduce, say, flood insurance. You put in flood measures. It allows for putting in backup generation so you don't have business interruption if there's a hurricane. So there's all sorts of other benefits that you can incorporate in how you look at the savings. I think also that's really important is for new construction, it's kind of primarily about reducing your equity and being able to use those funds where you need them. In an existing building, you're really basically saying, I have really old equipment on my roof and I want to increase my cash flow. So that's similar. And I can put in new equipment. And if it's, generally speaking, and programs differ, if it's more efficient than the equipment I had before, I'm able to use PACE. And again, this is a great way to be able to use your cash for other uses. And I think, as I alluded to before, we see a lot of larger projects. The biggest one on the East Coast is the largest to date, actually, and that's $89 million in New York City for rehab of an office building in downtown Manhattan. But we also see really small projects, nonprofits use it as well, that are cash constrained. It also works with solar structures. You can do PPAs with PACE. So it's a very flexible structure. I think that's really important to say, and can incorporate other kinds of incentives. I think that's probably all I can touch on right now, but happy to answer questions going forward.
Yeah, no, thank you. That was a tremendous overview. And I think we have about 20 minutes left together. So want to be mindful of the panelists' time and mindful of the audience time. I didn't know if any specific questions have percolated from the audience. Please feel free to put them in the Q&A box.
Hey, Jason, one thing I realized right now by looking at the Q&A, can I address it really quickly?
Certainly.
Yeah, and I think then after, I might want to have Ben also weigh in, but what was mentioned is that someone asked about residential PACE in Maryland, and it's not enabled to my knowledge in Maryland. And there's multiple reasons why PACE on the residential side is limited to primarily to California, Florida, and Missouri. There's some federal concerns with consumer protections that have been going on for a number of years. And we're currently waiting at the federal level for there to be a ruling based on that would establish what those consumer protections would be at the federal level. But for example, California has moved forward with some consumer protections, but I can say that we're looking at it in Virginia right now. And the major concern, of course, is what are we doing with the fact that there have been some bad actors? So I think residential PACE nationwide is going to be something that's going to work long term, but we're still kind of in a waiting period.
Yeah, Abby, I think you did a fantastic job summing that up. I could not do it better. I did notice that Kathy, our executive director at MCEC, did weigh in with an answer, just noting that our PACE is a challenge because of Fannie Mae and Freddie Mac guidance. Like you said, echoing what you said on the federal level, there's an issue with their guidance on the secondary mortgage market with or if there's a PACE lien attached. bankers then are not supportive of PACE being implemented at the residential level in Maryland. And then the only thing I would add is there is a link there, of course, to the CEA, the Clean Energy Advantage Loan Program that we are partnering with Montgomery County to launch statewide this year. That certainly is a way that we're at least trying to get some loan assistance, financing assistance for the residential market in Maryland.
Certainly, and there's some additional questions that have entered into the chat box. I think, Ben, for you, there's one about, are solar projects being implemented more than geothermal in Maryland? Are you able to see the question? Carbon offsets, ROI the same?
Yeah, I'm seeing them now. I will try and take a stab there. So are solar projects being implemented more than geothermal? So if I'm understanding that correctly, so it's, I think the answer is probably yes. I mean, I don't have the quantitative stats in front of me. My anecdotal evidence suggests that they are, but to make sure that I'm understanding, I would think geothermal, you're talking ground source, probably heat for commercial construction. And I would say that in terms of commercial facility design, commercial construction, I have seen more geothermal incorporated into large projects in Maryland, but then also in other places on the West Coast. I came from Seattle. Certainly we were doing quite a bit with them in Seattle and in California. So geothermal is something that I see definitely taking off, can have a nice life cycle cost kind of profile versus other sources of energy for a commercial site. So I think of solar and geothermal personally as just kind of like separate animals, but there is a great deal of solar, of course, development in Maryland, as there is elsewhere, because the cost of solar is going down. Cost per installed kW is decreasing, and so it's just a competitive energy source. And then excuse me. So, and then the next question, are carbon offsets and ROI the same? I mean, easy answer there is no, right? Carbon offsets are a specific way that individuals or entities can invest in some other project that is designed to reduce overall greenhouse gas emissions, carbon emissions. That could be something like, in fact, it can be an investment in keeping a forest. It can be an investment in some other clean energy project. And then ROI, as long as I'm understanding the question, that term is just return on investment. And that essentially just means the payback of a project that yields savings. So simple payback, return on investment are the same, different than carbon offsets. And is there support equivalent? Is the support equivalent, or are there barriers? And then I'm not exactly sure about how to answer that one. So support and barriers.
I'm guessing, is there like similar incentives, or, there's the investment tax credit on the solar side. Is there incentives for mobilizing more geothermal?
Oh, yeah. Thank you, Jason. Linking it back to the first question, I think, well, the support is not equivalent, and there are barriers for both and support for both. So that's a challenge. In Maryland specifically, with geothermal, you're looking at more like energy efficiency incentives that you would be able to receive on the commercial industrial side if you're doing geothermal development for a project. And then solar, you're looking at other maybe state or some other regional, even federal incentive. So different incentive structures, different support, and different barriers, but barriers for both, I think, is how I would answer.
Got it. And then Brian, I'd love for you to chime in. There's some Connecticut specific questions.
Sure. So just following up Ben's response to Rebecca's question. So in Connecticut, the short answer is it's probably infinite from the perspective of solar. So there's a ton of solar projects, very few ground source heat pump projects in Connecticut. If you were to project out the lifetime MMBTUs of solar to that of ground source heat pumps, it's probably infinite, right? So it's largely weighted towards solar. But stepping back, in the Northeast, New England states, New York, for the most part, we are fighting three climate wedges, right? So the first one is decarbonizing the grid. So solar PV helps to produce, in the case of behind the meter, in front of the meter, a reduction in emissions from the power sector. The second is moving our transportation related emissions to the grid, electric vehicles, hydrogen fuel cell vehicles, and the like. And then the third, which is, I think, a phenomenon of the Northeast, it is in New England, it's definitely in Connecticut, is that we heat our buildings with dirty, polluting fossil fuels. So in Connecticut, for example, we heat our homes with greater than 50% using heating oil. So those are kind of the three wedges that we're after, which ultimately leads to the policy emphasis on beneficial electrification. And when you look at that, what are the types of renewable heating and cooling technologies that fall there? The region, for the most part, has prioritized air source heat pumps. Ductless mini splits is kind of the area to focus in on. Although, ground source heat pumps do fall in that bucket. The industry, the ground source heat pump industry, is more nascent. There could be other policy approaches to try to monetize performance to encourage more deployment of ground source heat pump, which gets to my third area, which is that through the Smarty Loan program, we actually provide interest rate buy downs to try to encourage more ground source heat pump deployment, displacing heating oil. And we also provide free meters. And what we're trying to do is we're trying to understand the performance of those systems, because if we can understand the performance of ground source heat pumps, to provide heat during the winter, to provide coolness during the summer, then we might be able to figure out a way of pricing that benefit, just like we do with a lease or a power purchase agreement structure in solar PV. And if we could price it at less than the value people are paying for energy, then we've got an opportunity here to create a financing product. So we are looking at it that way. I thought, Rebecca, your question on carbon offsets versus ROI was kind of an interesting one. Obviously, when you look at renewable portfolio standard policies and renewable energy credits, in Connecticut, for example, we have a fairly clean grid because more than 50% is comprised of nuclear power, and then a lot of the rest is natural gas units. But when you think about displacing heating oil that ground source heat pumps would do in comparison to a reduction of a kilowatt hour on the grid, you're probably leaning more towards valuing a voluntary offset in the carbon markets versus a compliance credit in the rec market. So a really interesting dynamics there. A lot of people can do that math, but great question. We need to do more ground source heat pumps.
I think I'm on mute. There was a question about condos in the Q&A. I think I saw it was answered. The only thing I could add to that is there has been some precedent for using commercial pace for ground up construction for condos prior to them converting to residential. So on the developer side, it could work for that, but if it's an in-place condo and someone's interested in financing improvements, it would have to have a residential pace program. But as Kerry mentioned, there's other loan programs like the Catalyst that can address those. But there is precedent for ground-up construction of condos leveraging C-PACE. I think the most recent project was completed in Denver.
Hey, Jason, can I add to that real fast?
Certainly.
Yeah, I totally agree with that. That's actually, we're looking at one in Virginia that's like that. One thing I would add is that it depends on the legislation. So we're looking very closely to see if the state legislation, which the ordinance is mirroring, is allowing of that. So yeah, Colorado is a good state for that, but we're not sure, for example, the way our excluding residential would allow us to do condos. So I just want to point out to keep track of that when you're looking at that.
And Kerry, it looks like Adam had a follow-up question about the Catalyst loan and unlocking some of the capital for condos in Maryland. So maybe a combo of Kerry, Ben, to answer that question.
Oh, I missed that. Sorry. Let me see.
I think thanks, Kerry and Abigail. How can we get Maryland to become one of those states?
I mean, we offer the Catalyst loan nationally. We are not bound by any geography. As I did mention, there are some states where the energy prices are lower than Connecticut. Connecticut has very, very high energy prices. So there are some states where we can't only underwrite to energy and operations and maintenance savings, in which case we have to kind of flip into a more traditional property-based underwrite or a hybrid underwrite. But we can lend in all 50 states. So I think some links were dropped into the chat early on. Feel free, and I can put my email address in as well. Feel free to reach out on the website or to me. And happy to partner with Kathy and Ben on that as well.
Yeah, I think that could be a good, Carrie. I think that probably the best take home message is for us to talk offline about that. But then I would say definitely that we will help make that link for anyone who is tuned in Maryland and is interested. Feel free to reach out to us directly too.
And come to Virginia too.
We'd love to.
Well, great. Well, I mean, I think we always want to make sure that, you know, the topics of our future program are relevant for the audience. So I think we have one last polling question we would like you to chime in on. And while we're putting up the polling question, I just wanted to thank all of the panelists. I found this insightful. Hopefully our audience did as well and has a much better idea of bankrolling and building energy projects than we started, you know, an hour and a half ago. So we'll look at the results of the poll, and I'd like to turn it over to Kathy for closing.
Thanks, Jason. You all are amazing. And the work that you're doing in this space is just exemplary. Maryland Clean Energy Center certainly has a lot to learn and a lot to do. We are very anxious to hear from our audience about the types of projects that you're working on that you think you could use help with in terms of technical support, procurement support, or mobilizing capital to make the projects happen. Again, if you would click your toggle button for the results of the poll, we're looking what areas of interest you would like to see more about. We got lots of interest in stacking investments, catalytic capital for inclusivity, certainly a green bond program for Maryland. I want to hire Brian as a consultant and come down and have crab cakes more often. So we really appreciate everyone's contribution today. There are a few more webinars that we will be hosting in the next couple of weeks, 3 more in the series. Federal and state investment and incentives. I'm sure we'll have some lively conversation there. Workforce readiness for the advanced energy economy is on the agenda on October 12th. And then we close with a really great panel on innovation and looking at advanced energy and carbon emission reduction using cutting edge technologies and how we can help facilitate more of those business development opportunities as an economic development strategy for Maryland. I want to thank again Jason for moderating, our panelists for participating. I know you're busy people, so your time is valuable. We look forward to hearing from our audience again. And with that, we'll close the session for today. Thanks again. Bye.